This session is actually my personal most expected and anticipated session. I think everyone will enjoy and get a lot out of it. Traditional finance versus decentralized finance. Welcome everyone. Go ahead.
Cool. Yeah, thanks for having all of us here. I think we'll just start with a quick self-intro, like 1 minute each. I'll start with myself. I'm the founder of Sharding Capital, a crypto investment firm based in Singapore. Been investing in crypto for the past 3 years, and actually how I got really started is in DeFi. Known as Arthur 0x on Twitter, like early investor in synthetics, Aave, Sushi, DeFi, etc. Also went through the DeFi summer, so I think probably like very good topic for me. So we have been investing in DeFi, gaming and crypto infrastructure for the past few years, invested in more than 100 crypto startups. So yeah, I'm very familiar with DeFi. And yeah, so right now we are just actively investing from our fund. On top of that, I also sit on the council of DYDX Foundation. So yeah, a lot of mutual topics with the panelists here. Yeah, pass it to Cindy.
Hi everyone, I'm Cindy. I'm one of the co-founders of Drift Protocol. We're the largest derivatives DEX on Solana. We were founded about 3 years ago and focus primarily on perps and spot trading with a unique liquidity model that we call a liquidity trifecta. So it's a combination of on-chain order books and EMM designed to provide the deepest liquidity for traders. And my background prior to founding Drift was in crypto trading. So started in the space just really arbitraging basis and funding rates back in the day when the first perps launched. So yeah, been a fun ride since about 2017, 2018.
Awesome. Hey guys, my name is Naman. I'm one of the co-founders of ZKX. We're a derivatives DEX that launched with Starknet. As a background, I come from venture capital. Prior to starting off ZKX, I was running SOSV in Asia. Our first Web3 investment was actually BitMEX. That's where basically we kind of dipped our toes into Web3 in general. And along with we had a quite massive portfolio in emerging markets. And we realized that we need to create something which uses the stickiness of perpetual swaps, but it should be something that's aimed for emerging market retail users. And that's where the original idea started off with. And 3 years ago, we started ZKX. We recently went live on mainnet about a month ago. And here we are. Thank you.
Actually, it's not true. The first SOSV investment in Web3 was my company, BitMEX.
Oh, no.
So, yeah.
Oh yeah, you were also there. But it's a small world nonetheless.
I think William Balbin remembers BitMEX just a little bit more. So, hi guys, my name's Darren Camus. I'm the co-founder and CEO of iPor Labs. We build interest rate derivatives for DeFi. It's a very kind of TradFi instrument adapted for DeFi. I started my crypto journey back in 2011. I used to run BD. We were the #2 exchange to called TradeHill. #2 to MTGOX back in the day. So the industry has grown a lot since then, and I'm very happy to be building in DeFi.
Yeah, thanks for everyone. So I think that since the topic today is like TradFi / DeFi, probably we can just start with talking about. Probably I'll just share some of my experience. Like when people talk about like TradFi, DeFi, there's a few lenses. On the one extreme end is like I published an article 2.5 years to 3 years ago saying that DeFi will eat traditional finance. Obviously, I want to make the topic more sexy. I'm just saying that due to the open source nature and the very fast innovation cycle of DeFi, DeFi is just going to gradually take more and more market share from traditional finance, because traditional finance, as we know, have not really been innovated in the past 20 years. In fact, Blockchain Capital 2 months ago published a very, very good report, saying that fintech actually did not really produce any zero to one innovation. It's basically just slapping an API, a better front end on all the traditional financial rails. All the back end infrastructure is still the same. And on the other end, we also see some other angles saying that DeFi is like a continuum of fintech, saying that just make fintech more open source, is building on the same kind of like using software to transform finance kind of angle. So probably would love to get all your perspective. Probably I'll just share some of like my personal experience of this particular area. Is I found that the biggest issue of the TradFi and DeFi interaction is really DeFi doesn't really have that much intermediary, which in a traditional finance, this is very important because this is how the regulator regulate finance. Like they all regulate finance via the intermediaries. And in DeFi, you know, most of times we say that we are decentralized, we have smart contracts, although a lot of time the team have admin key. So like that's kind of like a gray area, but the lack of intermediary makes it very hard for the traditional finance firm to really interact with DeFi. Like, what do you guys think, like, how this will evolve? Like, do you gonna see more and more, like, overlap between TradFi and DeFi, or you think that there's always gonna remain, like, a separate world? From my view, I think for the next 3 years, at least, I think the biggest purpose of DeFi will still be to serve the on-chain wealth, like the crypto native, you know, like the TradFi people is really, I don't think the intersection will happen so fast, but we'd love to hear all of your perspective, yeah.
Yeah, I think you make really interesting points about still needing intermediaries. Because right now, even to get your money into DeFi, either you need to generate your wealth on chain already through like selling tokens or being able to service like native assets on chain. For instance, some of our biggest assets are not USDC alone, but Sol LRTs like Jito Sol, MSol. And our thesis is we're building a home for these assets that live on chain. On the flip side, what we've been seeing from the TradFi lens is that, for instance, BlackRock just launched their BIDL fund a couple of weeks ago, and very quickly already surpassed about 300 million in deposits, which is more than, I think, Franklin Templeton's similar fund that they tried to launch years ago. And I think the reason that this particular fund, which essentially just buys and issues tokenized treasuries on chain, has done so well, is that they are trying to make the tokenized treasury as fungible on chain as possible and fluid on chain. So they're working with DeFi protocols to, for instance, set up like permission pools to allow these treasuries to be traded. And I think this is pretty monumental because prior to this, there was no way that any person on chain could actually buy or gain access to treasuries. So I'm pretty bullish on innovations like this that sort of bridge the TradFi and DeFi world. And I think we're going to start to see a lot more of it.
I actually really agree with you, Cindy, over there. So something that we always say, and you know, something we kind of feel internally, the future of Web3 is actually Web 2.5. The absolute reality is that, I mean, if I talk about our as a derivatives DEX ecosystem, we fight for what, 15,000 traders globally and 34 market makers that make up the entire industry, realistically. If you don't have intermediaries, and there is a very massive dependency, you know, most of the market makers, when they bring in liquidity in general, you need the custodians involved, you need a lot of it. So really saying that DeFi is fully independent of the size and scale and the options that TradFi chooses, I think it's, you know, really being a little delusional, and we all understand that fully. Something that we have realized that when you say intermediary and evolving technology, both of these things are still quite needed for DeFi to truly evolve and as well as TradFi to be equally interested. In our case, we really felt that you know, having something like an account abstraction or something is really important to kind of abstract away the Web3 experience for us to pull in retail, but simultaneously institutional capital still relies and takes on the traditional sort of structures for it to really come to us. And I think that dependency still prevails very massively. BlackRock is a beautiful example. Suddenly, if you talk about tokens, when the RWA fund was released, suddenly all the RWA tokens started jumping up. But we in crypto were never really, you know, they were around for years, but nobody was really trading. So I think that effect is still massively there. And I think we should really accept that we are still quite dependent on growth for liquidity, liquidity coming from there.
Yeah, maybe I'll take this from like the technological side, right? If we look at from the not your keys, not your coins perspective, custodians are the most useless business inside of crypto. But if we look from a regulator's perspective, they're absolutely necessary. So this is something where we have new technology that wasn't built for regulation, it wasn't built for finance, it was built to experiment. And we have a bunch of things that actually don't match up necessarily one-to-one. So, for example, the idea of pooled assets can be a problem if you're going through traditional traditional finance rules, right? The whole idea that you have segregated customer accounts, but you break this if you have this kind of vessel which is 2 tokens and a bonding curve like a basic DEX, right? So this is something where you have the technology and the regulation that don't match up, but I think down the road these two will converge. And if we look at something like 2017, 2018, everyone was talking about institutional blockchains, private chains, and you fast forward to, I think, 2022, 2023, and you have, JP Morgan Onyx, which is actually publishing the proofs of its bond issuance on Ethereum main chain. So I think you'll have a lot of more convergence of these worlds, but it's going to take a lot of time to balance kind of these trade-offs on the technological side, on the traditional banking side, and I think it takes more of a third-way approach.
Got it. Yeah, like, I think we are certainly seeing more convergence, especially on the RWS side. So I think that's definitely one of the bright spots for the industry. We see Ondo, have like few hundred million of TVR on chain, and we're also seeing them like achieve like, I think 5 billion in valuation. Certainly a very strong vote of confidence from the market. I think moving on, we would like probably good to touch on, like, since all three of you are building a DeFi derivative project, like I think Drift and ZKX is folding on perpetuals, and then IPOI is focusing on the interest rate derivatives. So I think this is something that I think is a very, very exciting topic to talk about. I've been investing in the decentralized perps since like 2018, 2019. And then one thing I always found is, for some reason, the decentralized project are never as aggressive in the GTM, in the customer acquisition, compared to the centralized exchange. Like we see, during the past bull cycle, some of the like very new central exchange like BitGet or Bybit, they were only focusing on perps. They don't even care about spot. They'll be able to get like, probably like at least 10, 20 million users in like 2 years. Obviously riding on a bull market, and I generate crazy amount of revenue. I mean, I have the financials, I can't share, but I can tell you that they're insanely profitable. But we somehow never see that kind of like a very aggressive GTM from the perps, and also this is also reflected in the data. Like we've been tracking the market share of decentralized derivative to centralized derivative. Right now it's hovering between 3 to 5% for perps. For spot, it range between 10 to 15%. I think highest event is 20%. But I think that's because for spot, we kind of created a new market segment where the centralized exchange have not been able to compete fast enough, which is meme coins. The new on-chain coin launching, because they always want to, do some due diligence before like listing them. So it always like a few weeks like of gap. Even sometimes when you're 2 days, you're already late. So that's kind of the things that central exchange can't compete on, where like DEX, spot DEX have a edge. But it doesn't seem like perp DEX have this kind of edge, except for the pre-listing coin. There seems to be a little bit of edge there. But when I look at the volume, it's also not very, like significant. Like it's probably doing a few $1 million of volume a day. So like probably I think just a good topic is like, do you think this market share, how do you see it changing in the next 1 to 2 years? Do you think we'll go like from 3 to 5% to like 15, 20% or even more? And what do you think is really lacking like from the decentralized derivative project to really get to what the central exchange can get? Yeah.
Yeah, I feel really strongly about this because I think this is one of the things that DeFi misses the mark of, which is like, if you actually looking around the room right now, I'm sure there's more people using Binance than any derivatives DEX right now. And what's the reason for that? It's because Binance has the best customer support in the game. Well, maybe not always, but they have a lot better customer support than a lot of DEXs that maybe don't even have a Discord team servicing users. I think that's just one part of it. Second is regional expansion. Binance's customer support team, for instance, is probably 10, 20x larger than their tech team, whereas this is often the opposite case in indexes, where we focus so much on the technology that we forget about go-to-market and marketing. So I think there's a lot of room to grow. This is a bullish sign because, yes, we focus on the technology to make all of this open source. How do we bring it to the world? How do we make everyone use it? It actually takes a very, very handheld approach because it's not very intuitive to onboard onto DEXs. So that's one, a product problem, and two, a customer support problem, which is how do you go in person, like basically tell everyone, don't put your money on centralized exchanges, purely use DeFi. it's a repetitive thing, it's an operational thing, and I think a lot of DeFi founders tend to be coming from it from a very idealistic perspective, where it's like, okay, like I'm gonna build this and people are gonna come and use it. But I do think there's a lot of work to be done on just building an institution that can do sales, can do marketing. And this is something that we're focusing a lot on over the next couple of months. And that is also on the side of, yes, there's things that DEXs can do, but ultimately the main thing is being censorship resistant. Centralized exchanges can freeze your funds, can pause markets, liquidate users on your behalf, but that can't happen in a DEX. And sometimes you need to share the scary side of things for marketing rather than like pure benefits.
So something quite interesting over there. So in general, if you talk about, so if I talk about market share, right, the larger problem, especially we as DEXs, I think we get really stuck up on the fact that who is our user and how much of we being in a certain ecosystem or the technology stack we use makes a difference to the user. I think this is something which is, it's like you go to any crypto conference out there, right? Everybody's going to get excited. Oh, you're building on, ZK proofs, there's that. But the end user doesn't care. As Cindy said, if you don't have solid customer service, deep liquidity, offering, ease of use, that is what actually matters. And what we're trying to do, or I think the golden goose solution over here, is you try to get the best of both worlds. You're able to give them the execution, offering, ease of a centralized exchange, the touch points of customer service and regional language, the whole 9 yards. But you still give them the safety and security of self-custody wallets. And I think that is where the true solution lies. I think we get really hung up on the fact that we are builders building for builders, not really understanding that the end customer doesn't care if I'm on L1, L2, or L3 in the future. If I'm not fulfilling the basics, they just won't come to me. It's really that simple. And I think now this change is really coming. We are kind of coming out of our purist mindset, understanding so if me and Cindy in general, if there are 15,000 traders in DeFi, we basically fight for the same users. So either we can do that, or what we can figure out that there is like millions of users on Binance on the other side. Why don't we try to take a chunk out of that, which is more easier for me if I think outside the box a bit. And I think that is the difference in thinking and perspective that is really needed. Coming out of the product mindset and thinking like a business, making it profitable, reasonable for everybody. That's the bit.
Yeah, I agree with your guys' sentiment about the tech, about the support. I would say that most of the crypto people in the world, they've never done anything on chain. They have a Binance account with a login. So I think that there's this big gap, and I think actually this run will be centralized exchange heavy. What my bet is, and long term, since this is a TradFi to DeFi panel, is actually that we'll have again the merging of these worlds. We do have a very good product market fit in the perps DEXs, but that's because perps DEXs are effectively leverage speculation, right? We have a very strong fit of gambling products inside of crypto, but these are not really useful for long-term structural value. This is the one reason that we focus on interest rate derivatives inside of IPOR Labs. So if you look at IPOR, one of our advisors said, bro, you can't call it that because people will say IPOR. And I'm like, okay, understand, but you're talking about the 15,000 traders that we're trying to attract right now, right? What I'm worried about, so IPOR, its name comes from IPOR, interprotocol overblock rate, or a hat tip to the LIBOR. And the LIBOR is something that was used to structure around $400 trillion worth of deals, debt, and derivatives. And so I don't really care about being memed inside of crypto circles, because the long run, if this thing is going to be useful, is to get traditional financial actors in to bring like market stability, to bring these long-range products, to build this fixed income market. So we have a very good short-term fit inside of very short-term speculative products, but we need structure, we need market stability, we need maturity. Otherwise, I think that we failed as DeFi.
Yeah. Actually, that's a great one, since like you were talking about this. Like Darren, just focus on this. Like I have invested in 3 or 4 interest rate trading DeFi protocol in the past, they all failed. Like some of them still survive, but I don't know what's the latest for a while already. The only one of the one that I did not invest turned out to be like one of the most successful, especially in the last few months, which is Pendle. So Pendle also started doing some interest rate derivative, and also, but it didn't have that much traction for the first two versions of the product. They pivoted a few times, and I think finally, recently, they caught on the LRT wave. People want to speculate on points, not on the underlying interest rate. And also, I think some of the builders in 2021, they were probably a bit too early, right? So I think a key concern I have for this interest rate trading is that this is a very institutional product. Retail, even in traditional finance, doesn't really know how to trade it, so it's hard to understand. And you need to invest so much in investor education. So that as a startup, you generally do not want to spend the resources to do user education. So how do you think about that? How do you tackle the issue of being a bit too early to the market? The market just need a lot more user educations, and also just it seems that people still need a very strong speculation impetus to really push them to use this product. Yeah.
Yeah, I mean, I have huge respect for the Pendle team. I would say that the product market fit again comes from this product market fit in terms of gambling. It is effectively a leveraged pre-TGE way to speculate on the price of airdrop tokens. And that's really what people are using it for. But it's also a very usable instrument. We consider that, basically Pendle would be more like the bond market, and IPO would be like the interest rate swap market. And typically the swap market, the leveraged swap market is about 4 times larger than the bond market. But I think it comes from a lot of ways that, they've done a great job of actually, I would say that actually maybe Pendle has more to do with the success of onboarding people to LRTs than the LRT teams themselves, which is fascinating and really awesome. But yeah, so we launched kind of just before the start of the last bear market. We launched in August 16th of 2022, right? So one of our theses is that actually a lot of our natural traders died in the blowout from FTX, from Luna, from all of this, and sophisticated traders. But we actually have had a really nice pickup so we started with interest rate swaps. We effectively trade fixed for floating or floating for fixed exposure on USDT, USDC, or DAI, right? And what we found was that people aren't so worried about what they're paying for in terms of their borrowing rate on those instruments, but they really are worried about their staked ETH yield. So we had a huge pickup once we launched the stake rate swaps in December of last year. We underwrote 100 million notional in the first week after launch. And so I think that's a very interesting kind of flow. So one of the ways that we're looking at building or having this product market fit, we know traders are interested in either speculating or hedging something like the Lido staked ETH rate. And so from there, we can look at what were the basis trades of last year, not necessarily like more of the institutional products. So we look at something like Sommelier or like MEV Capital. These are guys that spun up, and they got something like 30, 40, $50 million in TVL, over the last year. And that was just the basis trade between ETH borrow and the ETH staking rate. Leverage loop and you farm the basis, right? The main thing that is missing here is actually the ETH borrow swap and fixed unit rate there, and the stake rate swap on the other side, because sometimes that basis inverts, sometimes you're actually paying. So this is a nice structured product, but it's missing the derivatives. Well, actually, it's not missing the derivatives. We have them at IPOR. So the question is, how do you fit all of this together, right? It's too much of a burden to give the end user the process to do all of the processes themselves. To go, to borrow, to leverage loop, to take the pay fixed swap, to take the receive fixed on the stake rate swap, to also monitor their position. Actually, this is why we built our next product, which was just announced last week, which is IPOR Fusion. And IPOR Fusion is essentially this generalized base layer. You can think of it 2 places, execution and intelligence. So it's effectively a layer that you can build these simple structured products on, and the end user doesn't have to care about it. So I think the simple structured products will be good for the subset of users that are very strong in capital allocation, but very strong in risk management as well. And another kind of key market we're targeting is actually traditional funds that are taking fiat subscriptions that are wrapping these on-chain positions and that really care strongly about risk management. So I think there's not going to be a huge product market fit at the start with the DeFi native degens, but there's this much bigger capital wave that's coming into DeFi, and I would argue that interest rate derivatives are one way that we can actually bring capital into DeFi. I can consider it a rail from TradFi into DeFi because you enter through the fixed income, and then people will go into the DEXs, people will go into the perps. So this structured product layer, I think, is one of the best ways that we can actually onboard capital and also give users this experience with one click rather than give them the burden of doing it all themselves.
Yeah, I think that's super helpful. Anything you guys want to add?
So, not exactly within interest rate swaps in general, but I would say in terms of, I really love the way how you guys kind of stitched it all together, you know, kind of figuring out the different target users basically and finding products that kind of intermerge and value is still concentrated. So in our case, what we realize in very simple words, if I talk about the overall user base or the community we've had, so you essentially have most of the users that actually come in. If I'm talking about emerging market users, these are users that love to, so what is the most, if you talk about the most used products in general, they're basically games, gambling, these sort of products, very gamified social aspect. And that is where we realized that even being a perpetual DEX, like you could create a user experience which is very much for traditional traders where you have multiple types of orders, this, that, the whole 9 yards. But that is not something which is sticky and fun. Because if I talk about emerging market users who have very less individual tickets, I'm talking like sub $100 of deposits that actually come in from these guys, but there are millions of them. And you know, 20 years and billions of dollars of venture capital went into kind of training them to a certain user experience. So we came up with something which was extremely gamified. Risk-hedged version of perpetual swap trading, the OG trade, where you just get market orders. It's basically, it's not exactly gambling because it's still a game of skill, not a game of chance as we call it. But it's super gamified and super easy. But the beauty is that this drives almost 80% of the retail volume within the exchange. Now, because in our case, we have like an app chain infrastructure, we have the same order book, which kind of works for pro trade and the gamified version. What it means that I have my market makers, institutions that use one side of the book, and I have my retail coming in from the gamified user experience. So by merging or differentiating user experiences by understanding the different kinds of users we had, we were able to actually make an order book where we actually had 57% retail participation on the books, which is extremely good because on an average DEX, we have like what 97% maker volume that's sitting over there. So I think understanding this bit and stitching it all together using the infrastructure of the app chain really helped us. And I think that's a great approach. We really aligned on that part.
Yeah, nice. I think moving on, I think this is like a pretty big topic, but I think broadly, there's 3 categories. I think one of the number one questions that all of you, when you were building the product, is like, which chain I should build on, right? So there's broadly speaking, 2 approaches. One is like, I'm gonna be like a chain loyalist. I'm gonna just pick the chain I like the most, which I think make the most sense. There's 2 considerations. One is the technological concern, like which technological architecture you're more bullish on. Some are Solana Maxi, some are like decentralization Maxi. That's why I only build on like a ETH aligned L2. And some like more like a chain agnostic. I just build on whatever chain that fit my technical architecture the most first. Probably would be good for like, you know, you guys to like, you know, share like how do you approach this design decision. Then the second aspect is really like the community aspect, right? Like, do you foresee yourself to be like, let's say Cindy, like, are you gonna stay on Solana for the medium term until, or like, you know, you're only gonna stay on Solana? Solana is gonna flip Ethereum and like, doesn't matter. All
other chain doesn't matter. Like, it would be good to hear this perspective. And the last but not least is, we are kind of seeing that more and more applications, especially those who've done very well, launch their own L2 or become their own app chain, which is what DeFi have done. There's a few reasons behind it, but I think I'll share a little bit of why DeFi did it is because after a lot of engineering research, we found that the Cosmos FTK structure is the most battle-tested one, battle-tested and performant one.
And also the only one that can really achieve closest to the true decentralization that we've been looking for, which is why DYDX turned on the revenue sharing, 100% revenue sharing to all the token holder when we migrated to the DYDX chain, the V4. And this is very hard to do if you do not have a fully decentralized architecture, because if you do not have that, you're likely to be labeled as a security by SEC, and that makes it very challenging to run the business sustainably, especially if you have any US nexus. But then we also see Avo, they kind of using like a ROB as a service, I think Conduit if I'm not wrong, and then they also say they're going to launch their own L2 as well, and then even the IDX side, they say they're going to enable general purpose smart contract as well. Everyone kind of gradually converging into like a general purpose smart contract chain. I think obviously another, I think more commercial side is that the market kind of value L1 chain a lot higher than the top app. So that from pure incentive, if you are like a very successful app builder, if you build a chain, then it's like a very like a low-hanging fruit for you to get your valuation out. And you probably have enough resource to build your own chain anyway. Because if you control the distribution channel, you kind of can bring the user in. So I think this is a pretty big topic, but feel free to pick which part you like the most to share about it. Are you going to launch your own chain, L2, whatever? Yeah, please share the alpha. Yeah.
Yeah, we started on Solana about 3 years ago, and the reason that initially we went with Solana over Arbitrum at the time was because it was the only chain that could support a fully on-chain order book initially, so pure tech reasons. And we saw a very strong developer community around Solana that we felt that would be easier to dive into versus going and building our own developer community. So there's a lot of synergies with the underlying base chain. But secondly, the reason that we stuck with it even throughout the FTX collapse and the crisis was actually due to asset availability. We see ourselves, as we kind of touched on the first topic, as the CME for crypto assets on-chain. And as we're seeing a lot of deep-in AI projects on-chain, we want to be the financial market where if you see these assets as commodities, you can deposit them and be able to trade them without the friction of needing to bridge everywhere. So I'm more of a monolithic maxi because I think that having everything on a single chain enables very unique use cases that you can create hedge positions or vaults that trade the underlying asset. And you basically share in the wealth of the entire chain. So that's a big concern and a big reason that we stuck with Solana. But ultimately, as we've seen kind of congestion over the last couple of weeks, as a perp DEX, we need to be hyper-performant, and we also need to be able to control our destiny and make sure that our traders are able to put their trades on in time. So one of the big things that we're considering is how we can sort of leverage the SVM and leverage existing technology to continue potentially keeping our on-chain order book on an L2 or an AVS type of infrastructure rather than keeping everything on the L1. Because our thesis is that you need to keep assets on-chain and on an L1, but the actual validation of trades can potentially happen on a sidechain or an L2. So yeah, that's something that we're actively exploring.
Awesome. In our case, when we started off, the core visions was kind of abstracting away the whole Web3 experience. And at the time, it was Darknet and I think ZK Sync, two ecosystems that actually had native account abstraction. Obviously, Darknet had tried and tested tech, DYDX, Immutable X, everybody was kind of there. So it was quite a normal choice to kind of go for somebody with tried and tested tech and a product. And they're really good at their tech. The other bits I won't comment on. But that's basically was our natural inclination towards Darknet in general. Now, how we really see this, the sole reason we actually created our entire app chain is during our testnet phase about a year ago, when we launched, within 3 weeks, we did 58,000 trades, $1.4 billion in trading volume. We were pumping so much volume, we took down Darknet's sequencer. True story. And that's when we realized that you cannot have any sort of dependency on the underlying ecosystems without, in a way, hampering user experience at some level. And that is the whole problem right there. If we say that potentially we're going to be competing out with the centralized exchanges, we can't say, oh, sorry, your orders didn't match because the chain was slow or something. You can't say this. It's nobody really cares. You're the product. You're the customer-facing end of it. That's where the
It's
action
kind of ironic
came.
that how all these like chains, they still trade at 100 times the valuation of top apps, right? Although like they can't even do a proper sequencing well. But yeah, go on, sorry.
Yeah, you rightly said. So the whole idea was that why have an app chain? Obviously, to be very frank, we never did it for the valuation upside of it because we had already raised capital before we started the app chain. It was a pure technological decision that we need something where the order book sits, but the order book needs to be unified liquidity. The users from all chains should trade in the same order book. That is what brings capital efficient market making. You could pull in more assets. It's just defragmenting liquidity and unifying it. That was our decision of why we went for the app chain. And when ETH was super high, I can personally tell you, we mint 2 blocks a second. We were burning like 10, 15 ETH a day before the action. So it was quite crazy for us. But right now, after the new upgrades, I think having our backend on Starknet has been extremely cost effective for us, which is great. And right now, the expansion strategy is you keep your backend over there, the user experience is abstracted away, and now you go to where the user is. Whether it's Solana, whether it's Berachain in the future, Blast, and it could be either be under the same ZKX brand name, or you could see the playbook out there where one derivatives DEX launches on another chain using the same stack under a different name, new token, which is also something that can be done, but I'm personally not a fan of that. I think it just scatters value all over the place. But that's the actual real story behind the overall decision for us.
Yeah, I think you guys took both kind of a tech-first approach. What we do is we take a liquidity-first approach. So personally, I'm blockchain agnostic, and I'm a fat protocol thesis believer. So we built first, we started the game on hard mode. We built on Ethereum L1 to build interest rate derivatives, which means that I think we're about 20% more expensive than a Uniswap swap, which is a pretty good technical achievement considering interest rate derivatives are much more complex. But if you start life on hard mode, it's easier to go to other chains rather than vice versa. Coming from an L2 where you don't have to worry about gas to come onto L1, it can be a really painful experience. But the reason that we did that is because of liquidity. In the IPOR manifesto, it's blockchain agnostic. It goes where the liquidity goes. So, because effectively the IPOR protocol, it underwrites interest rates, it should be deployed anywhere where there's a sufficient credit market activity. So, we basically look for liquidity. We look for where you can create these nice structured products. EVM is a blessing and a curse because EVM compatibility, because you have the liquidity that flows through different L2s, everyone's farming the airdrop, and then they go off to the next L2 to farm it. So what we're really looking for is staying power. So IPOR is deployed on Ethereum L1 and Arbitrum right now. From a liquidity perspective, the ones that we're really looking at are Optimism, Base, and Berachain. So really interested to see how these kind of get up and running, but we take a liquidity first perspective.
Yeah, cool. I think probably just take this opportunity to share with the audience any exciting development, any alpha from your projects in the next coming futures. We'd love to hear from that. And then just on a side note, I think we are running a bit short of time, but if we have a bit more time, I think one of the interesting topic is Ethena. Probably I think we can comment on it for 30 seconds. I think it's just interesting that actually Ethena is not the first iteration of this product. Actually, UXD did it. But I think what they did not do is UXD only did it on decentralized per Mango. And that kind of restricted how big they can get. Obviously, the timing was unfortunate. Then they have the FTX, all this thing happened. And Ethena did it, and it became wildly successful because essentially they are CDFI. They take all this deposit capital from DeFi and then put it into central exchange to capture the funding basis arbitrage, right? So it's probably is this the future of DeFi? You always have a big CDFI component to it. Probably just a good food for thought, yeah.
Yeah, I think it's interesting when you look at DeFi projects, they never succeed in isolation. It typically involves, I think, not the purist approach, but taking the practical approach. And these CDFI approaches are an improvement on pure CFI, so I'm all for it. And I think that it's interesting to go down that route. Yeah. I'd
always say go for, a large tried and tested sort of CFI approach. but sticking true to whatever security you can provide from the DeFi perspective of things. That's how we are really looking at it in general. I think there's a larger question of what you rightly said, that in general, how much do strong or giveaway incentive programs really attribute to success within bull cycles compared to bear cycles? Because that's where most of the products are built. But and I think we've all been through this, that what we start off building technically and how we actually grow it, it really depends on the overall cycle and the mindset of the users. A lot of mercenary liquidity, as we were talking about recently, it runs from chain to chain. We all try to capture it, but we all fully understand that we need to find the next leg, because this will just move on. So either we chase it or we get it from somewhere else, really, and that's where the dependency comes from within CeFi.
Yeah, I'm really excited about innovating in DeFi, because of CeFi is already, they have a lot of experiments. So I'm really, iPor Fusion, for example, think of it like the best of Instadap or DeFi Saver mixed with Yearn and intense-based execution. So what I see is a lot of liquidity fragmentation and rates fragmentation, which is also arbitrage opportunity. So the ability to be able to automate this is really exciting for optimizing your yield. But if you look at 2 days ago, it's also necessary if you want to actually go to sleep at night, where you can deleverage and de-risk. So this is the infrastructure that we're pretty excited about building today.
Yeah, Cindy, when token? This is alpha.
All I'll say is watch out on our Twitter tomorrow morning at 9 a.m. ET.
Okay, that's the alpha. Oh. Any alpha from you, Naman?
Very early summer, I would say. So we'll soon be releasing the entire timeline of events. So this summer would be quite an interesting summer for us. Let's put it that way.
Okay, cool. Thank you everyone for the time. Yeah, I think here we conclude this panel. Yep.